Hello. It's about time to take a look at NIO. It's been a while actually since we examined this Chinese EV maker. It's been going down pretty much every day. And if you take a look at the 1 year chart, you'll kind of see it very clearly. A massive downtrend over here, never really resting, pretty much going down and down and down and down. So there hasn't been the time to buy yet. Now, this is down about 80%, as you'll see here, so pretty much absolutely decimated. We will take a look at this company. It is a curious case. It's an interesting case, especially due to the fact that companies like Tesla have been skyrocketing in the past. A lot of people are actually interested in potentially buying this company, which could propel it upwards. So we do want to examine it in the case of a potential swing trade, even for people who are actually doing that, or of course for long-term investors who are looking to actually invest in this company for the long run. Is this the one that is going to actually be a high, pretty much a high gainer in the upcoming years? We'll see. Let's take a little bit of a closer look. Now, if we take a look at the stock news module here, it can tell us a few things about the company. Now, China EV sales on deck as zero COVID curbs rattle sector, pretty much. Chinese stock tanked this week, NIO Stock plans today. So the company has been going down and down, of course, because of what is happening with China, pretty much destroying their own economy for a while now. And of course, NIO is one of the companies that is getting decimated in the same manner. Now, if you take a look at the metrics page, and of course you do expect to potentially see a decline in the recent quarters of the company's doings, because obviously, their whole economy over there has been pretty much in lockdown, under a lockdown regime, and so you can expect a worse performance for a while. Now, in terms of the P ratio of the company, you will notice that even though it's negative, it is at least has been going higher. So it has been going towards profitability, yet it's not there yet. And the price to free cash flow is even worse, and at some point was actually positive. In terms of outstanding shares, take a look at this one. When the company's price was higher, that is, you'll see, starting from about like 2018 over here, if you go back to our chart, you can kind of see how the company started actually making some higher highs here in its chart, and they were over this long run pretty much selling and selling new shares, issuing new shares. And take a look at this run 2020 2021, where the company reached like $40 or so. They kept obviously selling as much as they could till it declined again. And overall, they have been printing like 5 times as many shares as they had some time ago, which is horrible. From less than like 300 million shares here to 1.6 billion, that's an insane amount of dilution here, which you obviously hate to see. Now, will they continue with that? We'll see, but it's definitely a cause for concern. And the company has quite some liabilities and not much free cash flow, as you'll see here. They have been increasing their revenue pretty nicely. That is the nice thing about it. So they have been selling, of course. So that's obviously very, very nice to see. And the 5 year net income growth has been doing a little bit better, but still in the negative. Kind of the same thing with the free cash flow growth here. And it's only the total equity been increasing because obviously more and more people coming out and getting their shares of NIO over here. Now, if you are potentially willing to buy some shares with NIO pretty much, you need to realize that when you're buying today, the previous dilution doesn't really matter to you. But what does matter to you is whether the company is gonna be continuing diluting you because they don't make money. So you want them to be making money as much as quick as possible, so that they avoid diluting you actually and actually buy back their shares instead of printing more shares. You don't want that. So you really need to be careful about potential profitability. Now, with the company stock price being down 80%, that definitely mitigates some of the risk, because the board will more than likely not be issuing a ton of shares as the company stock price is plummeting, especially if it goes down even lower. Now, the net income margins obviously of the company negative again. They haven't been making money, and this is a cause of concern obviously, and it's tough to have a pretty much an obvious buy price for the stock. If we take a look at the income statement here, you will see income statements. That is, you will see that the company's revenue have been increasing tremendously, very nicely over here. And in terms of their net income, in negative territory, and that's the bad thing about it. That's the thing that we definitely don't like to see here. In terms of the balance sheet, it's basically going to be positive, obviously, from losing money to 6 billion over here. But guess what? It's because of printing tons of shares. Take a look at this dilution going on here. Again, remember, 5 times as many shares, 12 billion here extra, 14 billion here, 5.7. Pretty much the quintessential way of making money from NIO issuing shares to shareholders. And that is definitely really, really bad to see for a company. And in terms of the total liabilities that the company has, it's about 7 billion here. If we take a look at their cash flow, you will see that they have been losing money again pretty much every year. And if you adjust just for some of the operating cash flow adjustments here for depreciation, amortization, working capital, and all that, it is only then when you're getting to positive territory. But again, you want it to come from positive net income and not from negative net income. This is really, really concerning here. At least it has been getting a little bit better. If we take a look at the quarterly periods here, you can kind of see that the same trend continues here, which is, again, something that you really, really dislike to see. Now, the investing activities cash flow, the company has been pretty much purchasing some investments here and selling some, but overall, there have been a net buyer over here. And in terms of the financing activities, pretty much getting some extra debt, as you'll see again. These companies are cash hungry, like EV companies, super cash hungry. So you do expect them to want more and more and more money. And so it can be problematic for an investor. But you see how that turned out for Tesla. At least they are selling a lot. But at what cost? I mean, it's their ratios are super high, and the company, even though it's down a lot, the stock price is still pretty expensive for what the company is making. Now the free cash flow here again in negative territory, going back from some positivity to some negativity as expected for this kind of company. Now they're not too far from actually making money here, but will that happen? That is always there's always some risk here. We can use, of course, our stock evaluation tool to see whether getting this kind of a lottery ticket potentially makes any sense. What kind of risk do we have here if we decide to do that? Now, the company's revenue growth that is, has been great, 50-year average of 60%. They have been growing their revenue at a tremendous pace. So I'm going to go 10, 15, and 20% here, which I don't know if it's going to happen for the next 5 years, but it's possible. It's actually very possible, I think, for NIO here. The big problems are the net income margins here that have been negative because the company hasn't been making money. And so what do we go with here? Now, typically these kinds of companies don't have high margins. So in order to gauge what kind of price I should be paying for their stock, I will go with marginal profitability. Let's just say that the company marginally makes 1, 3, and 5% in terms of net income here. Similarly, I'm going to use what most companies tend to do in terms of free cash flow margins. That would be about 80, 90, and 100%. And an annual return of 13% is what I typically ask for from my stocks. Now, again, this is gauging what it could make some sense to pay if the company was marginally profitable, which is not there yet. And remember, when you are not marginally profitable, you have to get extra debt, you have to issue more shares. So it's a problematic situation. Yet if we get a price that is potentially too cheap, it may make some sense to just buy a little bit and hold it for a swing, potentially a swing trade, see what happens after a few years, maybe even for this kind of business. Yet again, you have to always be aware of the risk, and there seems to be quite some of that over here with NIO. If we hit calculate here, you will see that we are actually looking at prices of like $2, $5, currently sitting at 9.6. Let's just go a little bit more in terms of revenue growth. Let's just try higher ones, which the company could potentially achieve because, again, they have been a company that has been flying in terms of revenue growth. Let's see what we get out of these values. And only in the case of the company doing something like 35% with a 5% net income margin, which of course really affects the outcome because now we're making more money, and 100% free cash flow margins over here, it is only then where the current price of the stock is actually fairly close to our high estimates. And this is nowhere near happening anytime soon, of course. It could maybe happen, I don't know, maybe in 3 years, 4 years, 5 years, who knows, maybe never even. At some point, the company could do that, but it's not close to achieving that yet. So right now, the only one that makes probably some sense potentially would be buying this company for like $4 or $5, and still it would be expensive. It would be a lottery ticket. But again, it could play out well because of the massive decline and a lot of people potentially interested, like the trend in these kinds of companies like EVs, coming from companies like Tesla, for example. But it would be pretty much a swing trade aiming to gain some money, not really a very, very good long term investment here. I would be very, very scared of potentially owning this one, even at these low prices. But at $5, you may as well get some and see how that plays out potentially if it reaches that point. But do tell me what you feel about NIO. I think we pretty much examined it quite significantly here. We did see some ways around the financials of the company, what they are doing, and what we expect them to do in the upcoming years. But do leave a like, do subscribe, and do tell me what you think about this company by leaving a comment below. And remember, you can always become a Patreon by getting there to our Patreon page. You can find a link in the description box below this video if you're interested, and I'll see you in the next one. Bye bye.